Marc, when you said that private credit is having something of a moment with the financial press, not surprisingly, somebody asked a question. And what you were referring to, if I may summarize, there have been a handful of bankruptcies among private borrowers in the United States, a few sudden write-downs of debt on people's books, and many questions about the credibility of asset valuations. And of course, the CEO of the world's biggest bank, Jamie Dimon, made reference to cockroaches, and that got everybody excited. Are these worrying signs to you?
No. And I'll repeat a little bit of what I said yesterday. And Jamie, I think, walked back the notion of cockroaches yesterday. But
this is yesterday being
in GIC Insights.
Yes. Okay. So, just so everybody understands, GIC, one of Singapore's two eminent sovereign wealth funds, had both Jamie Dimon and Marc as speakers.
So I think that the failure to appreciate both of those companies, I don't know if they're private credit or not. They were both funded and underwritten by the banking sector. And I ask a series of questions like, is a private loan to a public company private credit? I don't know. And we keep going through this definitional issue. But I would say the following. The size of the private credit market, as I see it, is some 41 trillion. Most of the market is investment grade. A fraction of it, some 2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the tricolors and the first brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic. I think what we miss sometimes by being focused on these couple of unique things is we miss secular change. Technology change is going to cause massive dislocation in the credit market. I don't know whether that's going to be enterprise software, which I could make the case is going to benefit or be destroyed by this. As a lender, I'm not sure I want to be there to find out. That's not part of the nomenclature or part of the dialogue. Businesses everywhere are going to be forced to adjust. Your competitor who adopts new technology is going to be totally different. The big secular shifts are what cause credit dislocation and credit losses, not, in my opinion, bad underwriting by one or two institutions, in this case, banks.